Hey, everybody, and welcome back to Teaching Tax Law, the podcast, episode 145. Today, we are going to jump into the One Big Beautiful Bill Act, but this time we're going to focus on real estate with a great guest. But before we do that, as always, let's take a brief moment and thank our episode sponsor.
Hi, Chris Picciurro here, founder of Teaching Tax Flow, co-host of the Teaching Tax Flow podcast, and pickleball enthusiast. Yes, if you listen to the podcast, you know almost every episode we talk about pickleball, the most popular and growing sport in America. We have tons of opportunities for paddles and pickleballs, but we don't have a lot of great gear on the market. Well, I'm so excited to announce that Sunsets and Dinks are now a sponsor of the Teaching Tax Flow podcast and produce amazing gear, not only to look at, but you feel confident on the court. Because you are part of the Teaching Tax Flow community, you get a 15% discount on all your orders with them. I know I love the gear I received, and I have quite a good record while wearing it, believe it or not, even at my level. Go to teachingtaxflow.com/pickleball and simply enter TTF15 in the serve up promo code area of your paddle rack.
Hey, everybody, and welcome back to the podcast. Obviously, as I always say at the beginning of these, and again, if you're an avid listener of this, you know these little mannerisms, I guess, is what I'm saying here. But at the beginning, I always say, don't be lazy and look at the show title and the description because it tells you what we're going to talk about. But what it may not tell you is that our guest back on this one, he's been here before. You know, he's been around here a couple of times. He's been in the industry even longer. So and I'll let Chris introduce him here in a minute, but obviously this topic, we touched on one last week, right? So we're looking at the One Big Beautiful Bill Act. Last week, we talked about individuals. This week, we're going to make the little trek into real estate specific. So as we get through this discussion, you're going to notice a few things here that really are specific to real estate, but then also, I believe that our guest is going to talk about something that kind of goes beyond it, but then brings it back in, and you'll see how it impacts real estate specific. So before we get into the guest part and the topic, Chris Picciurro, welcome back, sir. We open the gates. We let you come back into your own show. So here you are. Welcome.
John, I would say I did my hair because I'm so excited about the return of our special guest. But you know, I don't have a great hairdo. But I think bald is the new mullet, and I think our guest would agree. But I wore my favorite color shirt. So if you're not watching on YouTube and you're listening, first of all, thanks for listening. Second of all, go check out the YouTube video of this. I'm so excited to welcome Scott Saunders back to the Teaching Tax Flow podcast. We're going to dive into some of the real estate provisions in OB3. Scott's someone that our firm has worked with for many years. Him and his team do an amazing job. They've helped me out personally, saved my butt in a pinch personally once, and I'll be forever grateful. But Scott, it's a treat to have him on the show because he is a senior vice president at API, which is Asset Preservation, Inc., and he is a nationally recognized speaker. He's speaking tons I don't know how many engagements you do a year. I would gotta imagine at least 50. So instead of course, in-person events are amazing, but if you're listening or watching, you're in for a treat because you didn't have to buy the airfare, buy the admission seat ticket, and pay all the costs that you would usually need to pay to listen to Scott speak. So Scott, welcome back to the Teaching Tax Flow podcast, post OB3.
Yeah, Chris, great to be with you. You're right. Post, we got some certainty, and I'm happy to kind of unpack why these new tax laws are good for real estate investors and some of the implications. So looking forward to digging into that and fleshing out some of those details.
Well, we are excited also. We did, like John said, we did mention, some of the provisions that help individuals. We're going to do one on business owners. We're going to do one on the state. There's going to be some overlap, no doubt about it, but you cannot be too informed about this tax bill. This is a major overhaul. But let's jump into an area that you intimately know and you are involved on a daily basis, managing an amazing team. The 1031 exchange, was that affected by OB3? And then maybe we can run down some of the other provisions that touches real estate.
Yeah, the 1031 exchanges were not touched at all with this new tax bill, which is great news. So a little bit of context for that. Over the last few years, with the previous administration, they were attempting to cap 1031 exchanges at $500,000 per taxpayer. So, married couple, $1 million, which, when you think about it, some people go, well, that sounds like a lot. Yet, if you're in a market that's appreciated, the coast, California, New York, Florida, you could have bought an asset 20, 30 years ago and had that much appreciation in just one single family rental. So, there was a concern, and we spend, to give you a little background, Chris. I help lobby for the industry along with National Association of Realtors, and I probably meet once a week with somebody on the Senate Finance Committee or House Ways and Means, so on the tax committees, and we educate them just on the economic benefits of Section 1031, how it creates close to 1 million jobs, and how it stimulates transactions. So, to answer your question, 1031 not affected, and to me, we got a lot of certainty. What's kind of nice about having this bill done, and let's take, not look at the political side and all the other implications, but we have what we have. One of the big things that's a nice takeaway is we now have certainty. And I think there's a lot of value in that for business owners, investors, and taxpayers. When we had the Tax Cuts and Jobs Act, we had different provisions like bonus depreciation that phased out, and we had a bunch of things that were going to end at the end of this year. And what that does to investors is it creates a sense of uncertainty, and they don't know how to move forward, or they're at least tentative. And by having tentativeness in the economy, it's not good for anybody. So what I like about this bill is that so many of the features are permanent. So as real estate investors, we now have, we know what it looks like. Now, when we say permanent, I'll do that in air quotes, right? Things are like this until we get another administration with, that maybe changes things down the road. But for the foreseeable future, what we have now doesn't have a sunset provision where it expires. And so to me, when it comes to 1031, capital gain taxes wasn't changed, carried interest wasn't changed. The net investment income tax stayed the same. So a lot of those things stayed the same, and now we've got certainty there. But we did get changes on other areas too, so that a lot of those are very positive for real estate.
So, Scott, here's a question for you. Did you
Yeah.
read all 1,000 something pages?
Oh, that's a good question. And Scout's honor, no, I did not read the entire bill. I did not.
I want to find the person or people that did and basically say, man, I wish I had that much time and focus to do that. I don't know if that's a positive or a negative if they did it, but you did bring up a good point here too. Certainty, right? So that's something that we don't see a lot, but as you kind of alluded to, I mean, what a great thing to have. I mean, Chris, even, kind of crossing a little bit of a bridge, right? You guys have really built that into your private practice, price certainty and with clients there. So, I mean, Scott, you're talking about this as a market or in the market as a whole, right? Like, what a beautiful thing, right? Like what, even down to, I mean, the total extreme. What if we knew that gas prices were going to stay the same every day, right? It might be good, it might be bad, but you can plan for it, right? So that's a huge thing, right?
Yeah, John, that's great you brought that up. Planning for it, right? An investor, if you just think about what we do as an investor, we take capital today, we part with it, right? With the expectation in the future, we're going to get a return of some sort, whether that's appreciation, dividends, income, but we're parting with capital that we can use today to put it aside in the future to have it grow and multiply in some fashion. And now we've got laws that at least we know the rules are fixed. And so it makes it easier to make decisions. It's very tough when you're presented with all these different investment options to make a decision when you don't know exactly what's going to happen and you're just wondering. So I think the marketplace, as they begin to digest this, I think this is going to be net positive for people, knowing what the rules are and then being able to start to execute and then weigh the pros and cons of different investments, real estate or other investments, knowing that. So that's a big factor. I call it the power of certainty. And I think it's going to be a little bit of a relief, not only to tax preparers, but to investors to say, okay, we know the rules. Now we can operate in this sandbox knowing what the rules are.
Yeah, talk about planning, right? It's the same with gas prices. Dumb analogy, but it's very related. If you knew that it was the same price from here to Florida, and I'm in Michigan, you might not have to swerve off the road at Buc-ee's, and Chris loves going there. So trying to get the best deal on fuel. If anybody's
All
watching
right.
this, he's shaking his head drastically.
All right, all right, all right. You had to bring up Buc-ee's. I'm going to give you a little tangent. The Wall Street Journal's lead article this weekend was about Buc-ee's in my little town, Palmer Lake, Colorado. If you see it, so there's a Buc-ee's trying to come in, and they want to go in this beautiful rural spot, pine trees, beautiful views next to open space, and the local community is not happy, and they're fighting back. Now, I don't know who wins. Unfortunately, I think the big corporations have a little bit more horsepower. But anyway, Buc-ee's and my little town, Palmer Lake, Colorado, was featured on the Wall Street Journal this past
Wow.
week. Big article about that.
Well, I don't. Yeah, I'm not going to talk about Buc-ee's today because I'm going to stay in a good mood. And couple things on Scott. Can you talk about I mean, as simple as possible? You mentioned carried interest in that part of what OB3 kept alive.
It is. Yeah, there was talk. The president said maybe we need to modify that. And in the final bill that was passed, that stayed the same. So that is a net positive for real estate. People invest in projects, and having a lower tax rate makes it so that they're going to invest more. If we had a higher rate, that would have dissuaded investment. So I think that's a positive for development and for real estate.
There's something else that I think, sticking with real estate, you might not think that this has an effect on real estate, but I actually think it allows people to potentially consider 1031 exchanges. And what I want to talk about also is opportunity zones, which I call that the cousin of a 1031 exchange. But the change in permanence to estate tax, I think that's probably the number one permanent. Like, I'll give you an example. I know John likes his gas example. My example is, in our private CPA practice, we're membership based and we're very transparent with pricing. Can you imagine going to a restaurant where there's no prices on the menu? You might order something, you might eat it, you might kind of enjoy it, and then it might be a price less than you thought. Wouldn't it have been nice to know it was less while you're eating the meal and thinking to myself, I wonder how much this is going to cost me? So I like that certainty. But yeah, can you talk about the estate tax and what you think that's going to play a role with 1031 exchanges? Because I feel like a lower estate tax drives people to have a little more liquidity and less amount put into real estate.
Yeah. So the estate tax is now increased to $15 million per taxpayer. So if you're a married couple, you're talking a $30 million cap. Anything above that then faces estate tax. When you look at, in terms of just doing long-term planning, that's a pretty high threshold. 30 million is a fair amount of assets. So what it means is, from an exchange perspective, people can continue to exchange from one asset to the next and the next, and continue to do that and build up a larger portfolio and be able to hand that off to their heirs, who get, again, as everybody knows, a full step up in basis to the fair market value at the time they pass away. That's a lot. I think something like 99.7% of America is going to be beneath that threshold. That's a really small group that's above 30 million. So again, that's a big benefit. That's a win for rural America, for farmers and ranchers. It's a win for the average American that maybe has a few assets and they want to go ahead and continue building their portfolio to pass on. So huge. I think that's a great thing. I'm really glad it came out that way. And I think a lot of taxpayers should be really fortunate. And again, for planning, if you're beneath those thresholds, it makes planning a lot easier. You don't need to go through all of the complicated mechanisms that you need to do if you're a really high net worth individual. There's always going to be a little niche market for that, but the average American is probably going to do quite well at that $30 million threshold.
Absolutely. And you think that, I think a big misconception when we look at estate tax is that people assume that if someone has $5 million worth of assets, that it's all liquid. And that could be very not the case at all, right? It could be all in their business, which isn't a lot of, maybe it's a lot of IP, maybe they have a lot of real estate that's producing income, but it's not liquid. So, there's a big difference between liquidity and your gross estate. There's no doubt about it.
Hey, absolutely. I've got a friend of mine actually in Tennessee, very successful investor, and he always just, as soon as he gets money, replows it into another project. So his net worth is very solid, but his liquidity is really not that much because he keeps putting it back in and growing his investments. So I think that's real common. Even in rural America, you have people that are land rich, but they're operating their business with kind of tight margins, but yet the value of the land is worth a lot, but they can't really capitalize on that in a lot of cases.
Right. And you mentioned capital gains remained unchanged, so we know that we have some lower capital gain rates on the
Yep, we
long term.
Yep, we do. Yeah, we've got the lower rates. Those two thresholds just continued on at the 15 and 20%. So again, those are good. Now, in my world of 1031 on real estate, I think people are better off, doing that. And the other thing you kind of alluded to, we've got the opportunity zones. These came
Yeah.
about. Senator Scott proposed these, and they became part of the Tax Cuts and Job Act. And the whole purpose of an opportunity zone was to take capital, draw it into these distressed areas where they needed some refurbishment, redevelopment, and to try and improve them. And it was a massive success. I forget the last data. It was a huge number. Many, many billions went into these. So opportunity zones, which they're kind of related. They're a different strategy than 1031. They're broader. You can use them for any capital gain. Sell a business, sell crypto, sell an art collection, your gold, whatever it is with massive gain. You can invest these opportunity zones. So the way they were before is they capped out. They had an end. They ended. Now they're around in perpetuity, so we can invest in them. They were expanded. It's a great one, and as you know, I don't know how much you've gone into it on other broadcasts, but any gain that you have after the 10th year is tax free. So there's an incentive to invest long term in these communities. What a benefit! Literally a tax
Oh,
free income.
we used opportunity zones significantly in 18, 19, 20, 21 because they were set to expire here in 26, I believe. We didn't see as much going on with qualified opportunity zone funds. I love it because you can, yeah, as you nailed it, just invest all your capital gain or a portion of it. And I want to think about like, we're all from different parts of the country. Here in Nashville, the Gulch was an area that was part of an. If you've been to the Gulch in Nashville recently, you see it's amazing. Yeah, there's some pockets, but that was part of an opportunity zone fund. I was just in Atlanta. Buckhead's a nice area, but there were some really rough parts there that have been redeveloped. In Detroit, Midtown looks fabulous now, and right north of downtown Detroit. I know that's where John's at. So I think it's been a swoon for people because ultimately that money is still staying in the economy, and they're still paying labor. Labor is paying payroll taxes. I would be interested. We'd have to look at our friends from the Tax Foundation. They break down the economic impact and the job gain or loss on all these provisions. We haven't hit that part yet, um, but that's phenomenal. And the other thing, Scott, I don't know if you've seen this. We always talk about, and you mentioned, I know you kindly mentioned before the show, our quick tips, quick reels. We have a whole on the YouTube channel, a whole quick tips playlist that tax strategies like to play together, they like to be stacked. So let's say you have a business owner that's selling his commercial building or her commercial building and could do a 1031 exchange with that, but then the stock in their company, they could do a qualified opportunity zone fund. So they could do both. It's not one or the other.
Yeah, isn't that great that the tax code has all these options? So you've got all these tools now at your disposal as an investor. And you're right. Use a 1031 on your real property, defer the
Mhm.
taxes, reinvest, redeploy it in something other. Use them something like an opportunity zone now for the other gain with the business and other things. So honestly, we're probably, from an excitement standpoint, we're at the most exciting time to be a business owner and investor. We've got all these great tools now at our disposal that we can use. And so I think it's really, incumbent on people to get with their tax advisors and find out
Yeah.
all that's in this and take advantage of some of these new provisions. There's a lot going on. Absolutely.
Well, I know there was two things I wanted to. I mean, there's so many things, and we're going to probably harass you to get some content from you down the road in the Teaching Tax Flow YouTube channel. But two things I wanted to touch on before I forget. The actually maybe three things, but I just had a meeting with a private CPA firm client. He's a resident of New York City. He's a doctor, and he now will be able to deduct $40,000 of state and local income tax instead of 10,000. salt. I mean, so what do we see with the salt tax deduction?
Yeah,
That's not what you put on your eggs.
now salt's important. I mean, think about it. For your average person, if you're in a market, and I know the Long Island market pretty well. We've got an office out there. Those property
Mhm.
taxes are enormous.
Yeah.
If you were capped at 10,000, now you go up to 40,000, and I believe it adjusts up by 1% every year. So a little index. That means
Mhm.
you're going to have more take home. You're going to have more in your pocket. That's good for everything. It's good for all investments. It's good for real estate. If you want to save up for a down payment on your first rental property, you're going to have more cash to do it. So I think that was a great outcome. And I know people in those states that were having those higher property taxes are probably excited to finally see some relief in that area. So that'll be, that one's not permanent. I think it sunsets out at 2030, I believe. But hey, there's a time window now to take advantage of that. And I'll tell you, a lot of people fought hard to bump that up. So that's a great provision for sure.
Yeah, absolutely. I know bonus depreciation got favorable treatment, which sounds good.
Favorable. It's great. So
Being
let's
friendly, right? That's
let's talk a
smart.
little bit about bonus. Let's talk because
Yeah, please
bonus and
do.
1031, those two concepts kind of link together. So bonus depreciation now, we get 100% bonus depreciation with no sunset. This is going to be a game changer in real estate. Commercial, I think it's going to get things moving. I think people are going to trade up. For those that qualify, and I'm sure you unpack that. It's a little complicated on the different types of income and all that. But bonus depreciation is a great strategy to take advantage of in the year of acquisition. So we're going to see that. Now, the downside with bonus is that you've taken all that depreciation up front. So if you sell it in a taxable sale, you're now going to have to recapture that.
Right.
So lo and behold, what do we have as a solution? The 1031 exchange, right? So then 1031 gives you away on the back end when you're exiting the asset, and now it's time to sell out of it. Do a 1031 exchange and redeploy it. So the perfect strategy is to marry those two concepts. Number one, take advantage of bonus when you acquire the asset to the extent that you can. Hold it. And then when it's time to exit out of that, take advantage of a 1031 exchange and defer your gain. And you can do that indefinitely over and over. So combine those two concepts. This is a big deal. And I'll tell you, this affects the whole real estate industry. Commercial
Mhm.
real estate has bigger numbers. So certainly it's going to have an impact on that. REITs, well, a lot of entities will do that. So commercial. The residential market, which I know well, and I'm a residential investor, you can take advantage of that buying a little $200,000-$300,000 residential property. Same way as commercial, it's just the zeros are a few less. And then the third one, which is a great opportunity, is the short-term rentals. Taking advantage of the short-term rental loophole where you only need over 100 hours and more than anybody else. So commercial markets affected, residential market, and short-term rentals. That's pretty much the whole real estate industry, except for new construction. That's a big component.
Right. So you've got the bonus depreciation as your appetizer, and then you've got your 1031 as a marvelous dessert, and then you could maybe we're all hungry today. I don't know. Maybe it's me, but then you've got owning that property. Well, as we wrap up, are there any final nuggets? I know there's some that you want to leave us with. I know there's some different credits. There's some new
Yeah.
rules with factory building.
Yeah, let me
And
let me give
again,
you
nobody.
let me give you two
Yeah,
little
please do.
nuggets, two separate ones. So I'll give them to you kind of in rapid fire. One, I think this tax bill really rewarded work, and so that's important to remember. First 25,000 of tips, not taxable. Overtime up to 12,500. So that means there's a reward for work, and the impact is going to be twofold. Number one, people can save up more for their down payment. They'll have more disposable income, after tax income. Number two, if you're a renter and a tenant and those types of things, you're going to have more money. And so I think some of these markets where you've got a lot of, let's say, healthcare workers, first responders, people like that, you might have some of them with more money. A market like Las Vegas might do very well because they've got all the casinos. So that's one takeaway. The other one on kind of the other side, pulling it back to a macro perspective, in this bill were all sorts of incentives to encourage real estate. Condos, a condo development, they're going to get an additional tax provision. Low-income housing gets some additional credits. The list goes on. And, there's something called the QBI deduction, which is now permanent, right? That 20%. That affects 2 million real estate partnerships. So overall, there were many things that were included in this bill that are going to be very positive for real estate. It's going to take a while for that to trickle into the economy. It may take a year, 2 or 3. You mentioned factories. New factories get a special expensing component if you're an owner user. That's a huge one to bring manufacturing back to America, which brings in not only manufacturing, but it brings in jobs and the incomes with that. So many positives there. I'm really excited about the next few years. I think economically, this is going to be very, very, very positive. And those people that take advantage of these provisions are going to win big time. So those are a few takeaways.
Awesome. Well, Scott, that's actually a great spot to even wrap this one up because as Chris, I believe, threatened everybody in a good way at the beginning of this, we're going to have you back on as always. This is great. It's kind of like reverse fishing, but like you keep trying to get away and nope, we're bringing you back in. So good luck. And yeah, I mean, this is a great topic, right? So we're wrapping this up. We did last week's, we did this one more specific on real estate. So as we dive into this a little bit more, we keep guys like this in our proverbial Rolodex, like Scott, because that way we can just pull them in, grab a nugget from it, and we can save everybody else the paper cuts by 1,000 pages of having to read the entire bill. So I look forward to it. And Scott, you're always welcome back, man. We love having you.
Thank you so much, and we appreciate it.
Hey, it's always great visiting with you guys. Always fun to talk tax and economics. So thanks a bunch.
Absolutely. And again, everybody, we'll dive into this more along with other topics. Be sure, don't be lazy. As I said before, show notes, if you're watching, it's probably below you. Depends on what screen. It might be off on the other side there. Follow some of these links. Reach out to Scott. Reach out to anybody from our team. There is that curated YouTube playlist specific on the one big, beautiful Bill Act. So check that out. Subscribe to the YouTube channel. Tons of content. We'll see you back here again next week on the Teaching Tax Flow podcast. Different day, different date. Same day of the week, completely different topic. We'll see everybody soon. Bye now.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.